The stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Hey everyone, I'm Alex 50, and I'm on track to retire at 50. I titled this video, What Works in Investing and What Doesn't? I'm going to try to save you a massive amount of time and money right now. You won't waste several years of your life on stupid things, on nonsense. You won't risk your capital unnecessarily. The information I'm about to share with you is extremely important. And I'll start with my favorite analogy. I love drawing parallels with the health and fitness industry. Imagine you have a problem, say you need to lose 60 pounds. How do people solve this problem? They solve it the following way: they sign up for a gym membership, right? But the gym and the entire fitness industry is a very dishonest business, in my opinion. Why? Because if you look at this business model, what's the goal of the gym owners? To sell us hope. They're all hope merchants. You'll get better, slimmer, maybe someday. And the administrators and gym owners don't actually have a goal for you to lose weight. What's important to them is selling you a membership, and whether you actually show up or not doesn't really concern them. Moreover, they actually make more money from people who don't show up. Their goal is to sell several thousand memberships so that only a few hundred people actually show up, so they don't wear out the equipment, and so on. I look back at my life. I was overweight pretty much my whole life. Struggled with excess weight, and at my peak I weighed around 265 pounds. Naturally, I signed up for a gym like everyone else. Went there for probably 10 years. Did squats, bench pressed up to 220 pounds, maybe even more. Did cardio naturally, how could I not? Took lessons from a trainer, a muscle-bound guy of course, and didn't lose weight. Probably even got fatter. Because what did they prescribe? Naturally, these questionable protein shakes, bench squat deadlift routines, and so on. And then I came to the conclusion that what I was doing was complete nonsense. And after reading the right books, I concluded that you don't lose weight through training, you lose it by managing what's in your refrigerator. And it took me, I don't know, for 6 months, I lost 60 pounds. Practically instantly dropped 2 or 3 sizes. Friends were shocked, many didn't recognize me, and they'd ask, how did you do it? Nothing special, I'm telling you again, I work primarily with managing my food intake. Now, when I go to the gym, I'm there solving different problems now. Living longer, improving health, things that are most important in our lives. I look at overweight women who come to the gym, guys with beer guts. And they're huffing and puffing under the barbell, running on treadmills, doing whatever. And I want to run up to them and shake them by the shoulders and say, hey lady, this doesn't work at all. What you're doing is nonsense. Don't do this, just forget it. Naturally, they listen not to me, but to some fitness instructors, and they don't lose weight. They quit, continue gaining weight, getting fatter, and so on. Why did I use this analogy? Because it's very similar to what's happening in the entire financial industry right now. Doesn't this remind you of something? It's exactly the same with finance. We have a huge number of financial media outlets. YouTube channels, podcasts, articles, financial blogs, you name it. I look at the content of all these channels and conclude that they're absolutely useless for achieving the goals we need. Living off capital, early retirement, a dignified old age, building wealth, and so on. Everything we talk about in financial media has absolutely nothing to do with this. Not politics, not macro analysis, not expert opinions, and so on and so forth. None of this plays any role. Let me emphasize this again. So what actually works? Again, it depends on your goals. If your goals align with mine, for example, my goal is very simple: to be able to decide at any moment what I want to do with my time. Accordingly, there are a number of factors worth paying attention to. Factor number 1, the most important, the simple fact that you're investing at all. A person who does this already pulls significantly ahead compared to their peers. Just the simple fact that you're saving something. But it's not enough to just save. The size of what you save matters. That is, Contributions, the absolute amount. How much money have you actually put into the stock market, into investments, or real estate? Whatever it is. Continued contributions and reinvestment. How much of the money you received were you able to return to the market and buy new assets? This is also very important. Time in the market. Obviously, take someone like Buffett, for example. Everyone tries to write books and articles about him. His main secret to success is only that the man has been investing for 70 or 75 years, if I'm not mistaken. That's it. This is the only factor, but it's not mentioned in any investment textbook. And if it is mentioned, it's only in passing. They talk about his brilliant ideas and so on. The main factor there is time. Why? Because time equals compound interest, and it works miracles over a distance of 15 to 20 years or more. It truly reveals itself over the long term. Risk. The next factor. It also matters. But not casino-style risk or gambling risk. Proper risk. People very often make mistakes with risk. They try to take risks in the market, but you need to take risks outside the market, in places where, conditionally speaking, it doesn't lead to significant capital losses. For example, this could be business, career, acquiring educational skills, and so on. Places where you're not risking your core capital. Next step. Working with our brains. So-called reprogramming. I'm going to pay a lot of attention to this on my channel. I'm going to talk about this a lot, because there's a quote from one of my favorite bloggers, Morgan Housel. He said in one of his articles that investing isn't about studying finance, it's about studying how people behave with money. And no matter how smart a person is, if they're constantly shooting themselves in the foot, even knowing infinitely more than you about investing, they'll still continue making stupid mistakes. I don't know, spending on luxury items, consumer goods, taking out mortgages, whatever. They know everything, but they keep shooting themselves in the foot. Why? Because they have the wrong programming. They handle their emotions poorly. They can't maintain boundaries with friends, relatives, whoever, and they just can't cope. Next, I love learning from mistakes. I'm not interested in reading success stories, because everyone's are different. But I'm very interested in studying mistakes, failure stories, because that's what's most important. Conditionally speaking, if I tell you how I made capital in my businesses, it won't teach you anything, because your path will be different. Maybe you won't make capital in business at all, but for example in your career, or through a fortunate marriage. Accordingly, mistakes are the same for everyone, and they can be analyzed. Examples of such mistakes include improper handling of marriage agreements. This threatens every other investor. Does anyone even care about this? No. The next important determining factor is the choice of asset classes and their ratio. That famous Harry Markowitz theory you periodically encounter in books. What matters isn't which stocks we choose, but if we have, conditionally speaking, stocks, bonds, real estate in our portfolio, maybe commodities. And in what proportions. That's what matters. Not whether you bought Microsoft, Apple, Tesla, Amazon, McDonald's. Doesn't matter. Now, if I look at subscriber questions that they always send me, what they ask themselves and what they ask me is what to buy. What's in your portfolio? Which broker to choose? Will there be a crash? Will there be a second recession? Will Bitcoin reach 1 million or turn to zero? When I see these questions, I grab my head because I understand that the person is infinitely far from their end goals, because answers to these questions won't bring you any closer to financial independence, to retirement, to large capital, to nothing. It's just background noise. I recently posted a table on my Instagram showing what I can influence and what I can't. Let me try to show it here on screen. Let's say we have a column labeled, I can influence salary. Can I influence it? Of course I can. Change jobs, develop skills, improve qualifications. And accordingly, this will be reflected in my salary. Can I influence business income? Of course I can. By cutting costs, increasing revenue, marketing expenses, whatever. Can I influence savings? The amount of money saved? Of course I can. Expenses related to, for example, choosing investments, how to manage my capital, how much I spend on this percentage-wise. I can control this. Taxes, same thing. Let's say if I choose the path of an investor, my taxes are laughably low. Some 15% capital gains tax I pay, and this is just very little compared to what, for example, a person working a W-2 job pays. I can influence this. Various non-market risks that I often talk about, like divorce. The divorce process, by protecting yourself with a prenuptial agreement, you protect yourself from future problems. I can influence goals, what do I want? And strategy and tactics, having studied several strategies. For example, dividend or passive index investing or growth investing, I can reach goals faster. These are things I can influence. Now the list of what we can't influence. Stock prices, can we influence them? No. Exchange rates, can we influence them? No. Politics, whether American authorities or whoever else, can we influence this? No. News, do we influence it? No. The profits and revenues of companies in our portfolio, do we influence them? We don't. Company management, we don't influence. Economic crises, we don't influence. Federal Reserve interest rates, we don't influence either. My question from this is, why the hell then are 99% of all media devoted to this right column? Things we absolutely cannot influence at all. Why are we discussing this? What benefit does this give us? Will it bring us closer to our goal? No. And at the same time, find me? I don't know. Even 2 to 3 other sources, whether it's a YouTube channel or podcast, where they talk about this left column. There are only a handful. I collect authors bit by bit, subscribe to them, engage in dialogue with them, invite them as guests, where they say at least something about this, about salary, business income, savings, whatever. The rest is just nonsense. What will the exchange rate be? Who cares? What does that do for you? As a consequence, you need to ask yourself the right questions. When goal setting and asking yourself the right questions, that's, I don't know, half of success. Questions like the following. Are my goals correct? Am I moving in that direction? Yes or no? What's my income now? If my income is microscopic, I don't know, $2,000, $2,500 to $3,000 a month. What wealth? What capital can we talk about? What have I done to increase this income? Taken some courses, attended seminars, found a partner, mentor, something? Have I done this? No. Have I invested in self-education? How many seminars have I attended in the last month, 2 months, year? 0. Then what are we waiting for? Business income, do I even have a business? If not, then again, I need to think about career. About liabilities, look around. What can I sell? Something may be inherited, I don't know, some vacation property, unnecessary land, maybe an extra property. We have many such people who received real estate as gifts from previous generations or inheritance. Do I have this or not? Can I sell it? Do I need it? Next question, how to live longer? I'm using Buffett's formula again. His main success factor is that the man has been investing for over 70 years. Our task boils down to starting young, from age 20 to 25, trying to stay in the market as long as possible. And then we're simply doomed to become wealthy. There's simply no other option. As a consequence, everything comes down to getting into the market early. I tell my daughters, I say, girls, excuse me, but if you start at 18 to 20 years old, you'll have a huge giant head start over your peers. You'll just overtake them. You won't retire at 35, maybe even at 30 or earlier. I also talk about therapy a lot. Have you been to a therapist? You'll say, well, why do I need this? Why do I need a therapist? To get rid of all those mental blocks like, I should have a house, cars, vacation home. All these stupid things we have. I deserve this. You come to a therapist and start discussing, doctor, this is hindering me in life. I can't get rid of it. People constantly reproach me for something, try to make me jealous, or maybe guilt, or something else. This is hindering me. Let's remove it. They sit down, start digging inside, find all these stupid beliefs that society has instilled in you, and slowly remove them. Session 2, 3, 5, 10. You no longer have this. Have I protected myself from non-market risks such as divorce or something similar? Do I have protection from market risks? Do I need to fear inflation, currency devaluation, and so on? I, for example, don't fear this at all. I know that inflation is my ally. Devaluation doesn't scare me. I'm ready for cataclysms. I always have an answer ready at any moment. I have a cushion, a bond cushion, cash reserves. I know that if the market drops tomorrow by 50%, 70%, 80%, I'll have something to buy with. I'll repeat this trick again and again. Are you ready? Next, your circle. Who do you spend time with? If your circle includes people, even virtual people in the form of YouTube channels, podcasts like mine, how much time do you spend with them? Or are you listening to people who haven't gotten one step closer to the goals you need? Why do you have them in your circle then? Spend time with those who are already on the other shore. Fortunately, these people are open, ready for dialogue, for communication, ready to share information practically for free. Investment strategies. Have I mastered at least something on this topic? Do I understand the difference between, for example, dividend strategy and index passive strategy? What suits me better? Think about it. Next factor, if you just sit down for half an hour and think, where can I get more money? How can I earn more? How can I make my business generate more money? Or am I spinning like a hamster in a wheel all day and don't understand how to break out of this cycle? And finally, a simple question: how many books have you read? Look back at last year. We had time to sit at home during the pandemic. How many books did you read last year? And how many of them were about investing? 0. Same with seminars. Information is lying around for pennies, sold for $10, $20, $30. It's right under your feet. Take it if you want. People have chewed everything up and even posted it for free access on YouTube. Now let's sum up. Look, I've listed a huge number of questions, and my main question is there even a word here about choosing stocks, choosing some instruments, and other important skills and aspects that all financial media feeds us? No. Then again, the question is, why the hell are we listening to this? Why are we watching videos with forecasts about what the exchange rate will be in 6 months? Who cares? It makes no difference. This won't bring you any closer to wealth. And I also want to note the main secret of success in the market that I constantly emphasize. Often it happens that I look at my surroundings. Some critic writes about strategies like, this person didn't make it in the market, they made their capital somewhere else, in business or employment or something, they're not a real investor at all. I ask them a question: listen, is a real investor someone who juggled securities, gambled on Bitcoin, on Tesla, or what? It's precisely the person who is able to accumulate capital and preserve it, not squander it on consumer goods, not get trapped in a mortgage or something. They are the investor. And then it's just a matter of technique. The investing process itself is primitive, nothing complicated. The hardest part is saving, postponing consumption, learning to earn more. These are the two hardest things. No investment book will tell you about this. They'll tell you about anything else, choosing securities, choosing asset classes, but no book will teach you how to get the money to invest in the first place. What's the main conclusion here? Look, if you're working with small amounts, saving some measly $50 a month, you'll get capital of several $100,000 in 10 to 15 years. This is a brilliant result, no question. But it won't allow you to live off capital. Yes, it's great. It'll be a small addition to Social Security. That's also great, but you won't have the opportunity to live off capital. So how do you become wealthy? Becoming wealthy is very simple. You need to take your hard-earned money, somehow get $50,000, $100,000, maybe $150,000, $200,000 and put it in the market. And then the market will do its thing without your participation. Over 15 to 20 years, it'll likely grow your capital to $1 million if you factor in principal growth plus dividends. But you need to get that seed capital somewhere, those $100,000 to $200,000. You'll ask where to get them. Well, there aren't that many ways. There are only 3 or 4 legal ones, and one illegal one. Just steal them. From the legal methods, what do we have? A successful business. Obviously, create something from nothing, the business takes off, and you either sell it or feed off this cash cow. Number 2, climbing the career ladder. Developing personal skills. People will pay you a lot for your expertise. A fortunate marriage, please. There are plenty of examples where someone marries into money, and then that person passes away or there's a divorce or something, and they walk away with a decent chunk of capital and live comfortably off it. This is also a path. I don't condemn it. Inheritance. I'm looking at real estate prices right now, and I understand that every other person in major metro areas is a real estate millionaire, a potential early retiree. How did people get their properties? Mostly through inheritance from previous generations or family wealth. This is unusual by capitalist standards, but one way or another, this capital just fell from the sky out of nowhere. All 4 of these paths involve risk, primarily time investment, yes. We have an interesting feature here: we risk time and get tens of thousands of % in return. For example, in the case of the career ladder, it's just taking the right seminars, courses, finding a mentor, and so on. Your investment of several $1,000s in this will pay off for your entire career. With a business that takes off, it's even simpler. All my successful businesses had expenses of maximum $10,000 and often just $500, and the returns were just some insane tens or hundreds of thousands of %. And we continue playing the stock market, using it as a casino. That's all I wanted to say. Finally, I urge viewers to subscribe to my YouTube channel. Definitely subscribe. And I definitely urge you to comment on my videos and hit that like button. Thank you very much. This was Alex50. See you all next time.